This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Corporate governance and the regulatory framework. The principles of corporate governance should be well known to you. It's a subject which comes up in a number of syllabuses. And we're not going to spend a long time lecturing this. It's covered reasonably well in the notes. But just very, very quickly, if you remember the definition of corporate governance, how companies are directed and controlled. And what we want to find it really in this chapter is why corporate governance is important to auditors. And of course, auditors are auditing the result of how a company has been directed and controlled. And if it is directed and controlled badly, then it may mean that the financial statements are unreliable. And in particular, what auditors tend to be frightened of is a very dominant chief executive. A chief executive who almost frightens everybody else in the organization, because that person can almost get away with murder. They come in and say, pay $500 to them, give me $1,000 out of the petty cash, and people just obey that person because they're frightened not to. Or if this person does not properly consult with other board members, then of course the judgment of this person may be adrift, and it may set the company on a course which is disastrous. And of course we're talking about business risk, and the reason we're particularly interested in business risk is there can be knock-on effects into the audit risk. The corporate governance in the UK and much of Europe is a principle-based approach. And in the UK it is not statutory, but the UK Corporate Governance Code is part of your syllabus for most of you and represents good practice. In the UK it is mandatory for companies quoted or listed on the stock exchange, and they have to comply or explain. In other words, if they don't stick with the requirements of good corporate governance, they have to explain to investors and the stock exchange why they're not, and the ultimate sanction would be their listing being suspended so that shares couldn't be bought or sold easily. In America, we have the Sarbanes-Oxley Act, which is much more procedurally based law. It's actually a law where the directors and the auditors have to actually sign off and make declarations and so on about corporate governance. And if they sign those off incorrectly, then it could lead to criminal charges. The 5 elements of the UK Corporate Governance Code, very quickly, are leadership. And the leadership, which basically means the directors, or as we say, those charged with governance, should be looking at the long-term success of the business. They should be looking at the strategy and thinking 5 years ahead, what will the business be doing? One of the requirements is that the office of the CEO, the Chief Executive Officer, and the chairperson are split. The idea is this splits power at the top of the company, so that it should be less easy for a very dominant, charismatic, bullying, single chief executive officer to steamroller policies through the rest of the board, because the chairperson is there to bring up concerns at the board meetings and so on. Effectiveness, the big element there is that non-executive directors have to be appointed. There has to be a balance of non-executive directors, which roughly means 50-50. The non-executive directors will attend board meetings and they get full votes. And their purpose really is to warn the directors, to review some of the decisions, maybe to rein back some of the enthusiasm that the other directors have. The non-executive directors mustn't be remunerated in any way which is to do with profits, so they give this independent advice. They will figure on a nomination committee The nomination committee is how new directors are found and nominated, and they will ensure that the new directors are found as though any other employee was being found. It should be advertised. You should look at the qualifications you need and the qualifications these people have. You should interview them. You should get the best people to be directors that you possibly can. Accountability, and of particular interest in this chapter, is going to be the Audit Committee. We'll see later how the Audit Committee plays a very big role in liaising between the company and the external auditors. Again, the Audit Committee is essentially populated by non-executive directors. Remuneration is going to set the remuneration of the directors. If you remember, a substantial part of the remuneration of the executive directors should be linked to profits. So what's good for the company is good for the shareholders and is also good for the executive directors. But it shouldn't be set too high. It shouldn't be possible to get bonuses with very little effort. And it should be proper remuneration for the type of company and proper bonuses if you've really made a difference. And finally, there is relationship with other shareholders, relationship with shareholders. Shareholders were kind of their own worst enemy. Many were very passive. They wouldn't turn up to the AGMs. And it is necessary for the directors to try to encourage the shareholders, the owners of the company, to take full part in meetings and to take an interest in what their company is doing. Now, audit committees is particularly where corporate governance comes head to head, if you like, with external auditors. First of all, if we look to the right here, you see that the audit committees, they have work insofar as they review internal audit, if internal audit exists. So internal audit, companies have to keep the need for internal audit under review, and almost all listed companies will have internal audit. It is much more pleasant if internal auditors can report through the audit committee rather than having to report through the finance director. Reporting to the audit committee gives them much more independence and safety, really, and power, rather than reporting to the finance director, who may have been responsible for employing them in the first place. There is a requirement in corporate governance that the directors establish a good system of internal control, and it is part of the function of audit committees that they review the system of internal control, and of course they will review the letters sent by external auditors to the company, pointing out weaknesses in internal control or where the procedures may not have been followed properly. They can organize special investigations, maybe to investigate a fraud, maybe to look at value for money for some of the services. And they will monitor the integrity of the financial statements. Again, very useful to external auditors. The audit committee will be looking at the financial statements, trying to almost themselves assess whether they feel statements give a true and fair view, whether the judgments and opinions which are inevitably reflected in the financial statements seem to be fair. In liaison with the external auditors, they can set the scope of the external audit. To some extent, the scope of the external audit is set up by statutes and by the auditing standards, but there's still a little bit of perhaps leeway insofar as maybe internal audit can carry on some of the investigation that external auditors would normally do, or maybe if you have a company with 100 branches, how many should the external auditors actually visit? It's going to be a forum to link the directors and the auditors. So directors run the company, they produce the financial statements, the auditors are auditing them. There may sometimes be issues at different points of view, and the audit committee, one of whom should be somebody with financial experience, can act as the liaison point. They should deal with auditors' reservations. Perhaps the auditors think that inventory is overvalued, or that something hasn't been shown properly in the financial statements. And the auditors, in a way, can complain, I suppose, to the audit committee, who again can bring it up in the full board meetings, rather than perhaps keeping it the finance director kind of suppressing it and keeping it a little bit secret. If the auditors find it difficult to get information or to see documents, the first really place to complain is going to be the audit committee. The audit committee should know that the external auditors have the right to see all information and to get all explanations which they require, and the audit committee can back up that legal right. The audit committee should also look at and review auditor performance. Have they done their audit on time? Do they seem to have come out with reasonable arguments? Are they happy about the kind of judgments that have been made by the external auditors and so on? Are they happy with what's been said on the management letter that's sent usually after the interim audit, showing weaknesses in the system of internal control? Do they really seem to understand what the company needs and how to carry out a good and efficient audit? The audit committee will also review and monitor the external auditors' involvement with non-audit work, perhaps doing tax, perhaps doing, we'll see later, looking at reports on due diligence or on cash flow forecasts and so on. There's always a potential little bit of conflict going on here. You're doing the audit, and of course you get another fee for the special work. Sometimes that other fee is very, very lucrative. There are always the dangers that the other work is really what the external auditor is after, and the proper statutory audit is just to kind of keep a foot in the door going on there. They should also be wary of maybe self-review threats going on, where the auditor perhaps gets involved in a takeover, looking at the accounts and the business of the takeover target, and then next year when it turns out that the takeover target has been a bit of a mistake really and not very good, are the external auditors going to be trying to cover up their over-optimism that may have occurred? And they have to assess the overall independence and objectivity of the external auditors. They want to confirm that there are no familiarity links or business links and so on. They will want to confirm that the partner and the staff are rotated as they should be to try to keep the independence and objectivity going, which is essential for a good audit. The regulatory environment. Sources of regulation are, first of all, self-regulation via ACCA, for example. The ACCA is a recognized supervisory body, which means that in many countries the law has, in a way, subcontracted to ACCA and other accountancy bodies the right to audit. And recognized supervisory bodies like ACCA therefore have the right to set their own qualifications and exams. They will look after disciplinary procedures, looking at the behavior of members, and they will look at the quality of the work and particular audits which members are producing. In the UK, the Financial Reporting Council oversees essentially reporting and governance of companies, and it will be responsible really for making sure that audits are properly carried out by members of the various accountancy bodies who are allowed to do that. Internationally, there is the International Federation of Accountants, IFAC. And the purpose of IFAC, we'll see another slide in a moment, is really to try to bring a uniformity throughout the world in terms of auditing standards and accounting standards, trying to bring up the quality of work internationally. And then there's finally the Public Interest Oversight Board, and again we'll see a slide in a moment, which tries to widen, if you like, the people who have an influence on, for example, accounting and auditing standards. International Federation of Accountants. Its purposes is to serve public interest, strengthen the worldwide accountancy profession, establish and promoting adherence to high-quality professional standards. And it's got various subcommittees. There is the IAASB, International Auditing and Assurance Standards Board. They issue ISAs, basically, and other assurance standards. There is the International Ethics Standard Board for Accountants, IESBA. They issue the IFAC Code of Ethics, which essentially becomes the ACCA rulebook, or a substantial part of the ACCA rulebook. And then there is the Transnational Auditing or Auditors Committee. This looks at international dimension of audits, in particular where you might have a company which is based in the UK, listed on the UK Stock Exchange, but there are investors overseas who want to look at the financial statements and who may want to buy shares in that company. But here, what is happening is they're looking at a set of financial statements which has been prepared in one country and they're from another jurisdiction. And of course there can be problems, if you like, in interpretation and understanding what is being said by a company in a different country under a different jurisdiction. The Public Interest Oversight Board. IFAC was judged as being too, in a way, narrow-minded, too blinkered perhaps. It was kind of a club of accountants for accountants. Yet when a set of financial statements is actually produced, there are many users of the financial statements who are not accountants, or certainly not members of firms of accountants. So you could have investment trusts, you can have stockbrokers, you can have banks who may be lending, you can have individual investors who may want to put some of their pensions or their savings into a particular company. And it was thought that maybe if you just have accountants who are the ones who are producing accounting standards and auditing standards and so on, that perhaps the output from these standards isn't really as useful as it might be to some of these other users. So what it does is it has oversight of the IAASB and other public interest IFAC committees, and kind of says, well, what about this? What about these users? Does the new accounting standard, does it really show in, say, the notes to the financial statements what these sort of users might be particularly interested in? Remember, the director's responsibility for internal control. Corporate governance says that directors are responsible for maintaining a sound risk management and internal control system. The control system is the control environment, and that is really what's sometimes called tone from the top, that the directors have to be seen to really value good internal control, and that almost culture then should be filtering down to the rest of the organization. If you don't have a good control environment, to some extent any procedures and rules that you have are probably going to be only taken semi-seriously or going to very quickly fall into disuse. And then there's going to be procedures, what should be done if an invoice comes from a customer, and we have to make sure that those procedures are operating properly. The effectiveness of the internal control system should be regularly reviewed. The need for internal audit should be monitored regularly, usually once a year. And as I said earlier, most listed companies will now have an internal audit department. And listed companies must report on internal control as part of their annual reports. So really quite a high requirement placed on directors with regard to internal control. It is not the auditor's responsibility to establish or monitor a system of internal control. What they have to do is to look at the director's report on internal control to see whether it seems to be consistent with what the auditors have found. In their audit report, they are likely to say, "We are not required to consider whether the board's statements on internal control cover all risks and controls, or form an opinion on the effectiveness of the company's corporate governance procedures or its risk and control procedures." But nevertheless, they don't have to report on it. But nevertheless, if they saw that the director's report was saying internal control is really good, and the auditors discovered that internal control was kind of non-existent, there's a kind of inconsistency between the director's report and what the auditors know, and that would have to be reported on, really perhaps as another matter. Well, really as another matter in the audit report. And as I've said here, they can make a report by exception if they feel that something really has to be said to the shareholders to make them understand that the directors are not really properly fulfilling their duties with regard to internal control.